The startup world is often framed in terms of milestones. In one corner, we've got the coveted unicorn badge, valuation north of $1 billion that signals prestige, potential, and the allure of something truly exceptional. In the other, the initial public offering, an IPO, a classic route to the stock market, liquidity for investors, and a statement that the company has arrived, so to speak. Both represent success, there's no doubt about it, but they mean very different things for founders, teams, and long-term growth. Choosing between chasing unicorn status or heading for an IPO isn't as simple as following a formula. It's a matter of timing, vision, and above all, what you want your company to become. Unicorns have an allure of magic about them, but the reality is far more complex. To reach $1 billion valuation, a startup needs not only an exciting idea, but also significant capital, the right investors, and often aggressive growth strategies. Unicorns are shorthand for success, yet the truth is that valuation alone doesn't always equal sustainability. Plenty of companies have hit the unicorn threshold only to stumble when scaling became unmanageable, or when the market shifted beneath their feet. What unicorn status does offer is credibility and clout. It tells the world that investors believe in your story enough to attach a monumental number to it. For hiring talent, striking partnerships, and gaining media attention, this can be invaluable. But the pressure that comes with it is intense. Once you're branded a unicorn, expectations rise dramatically. The focus becomes not just growth, but growth at a breakneck pace, which can sometimes pull founders away from the original mission of the business. The unicorn path can also bring questions of control. Venture capitalists backing these valuations don't do so for sentiment. They want an eventual exit and a return. That means that founders often find themselves caught between building sustainably and chasing the next valuation hike. For some, this can be energizing. For others, it can feel like a treadmill. Where a unicorn valuation is about private belief, an IPO is about public proof. Listing on the stock exchange brings scrutiny from regulators, analysts, and the general public. Financials become transparent, decisions are made under the watchful eyes of shareholders, and the quarterly cycle of results begins to dictate the rhythm of the business. For startups that are ready, however, the IPO definitely remains this ultimate symbol of legitimacy. It offers liquidity for early investors, giving them returns that they've been waiting for, and it allows the company to raise significant capital to fund future growth. An IPO is also a long-term strategy, placing the company on a path of accountability and discipline that can ensure longevity if managed well. But the risks are considerable, there's no way around it. The truth is, not every business is suited to life as a public company. The intense scrutiny can expose flaws that were easier to mask in private markets. Also, public listings demand maturity in governance, culture, and financial planning. A rushed IPO can sink a promising startup before it's truly stabilized. And for founders, it can mean losing flexibility as decisions now need to satisfy not only the vision of the company, but also the demands of a shareholder base. The choice between aiming for unicorn status or pursuing an IPO isn't binary, nor is it permanent. And that's the beauty of it. Some companies achieve unicorn status as a stepping stone to a future IPO. Others forego public markets entirely, remaining private and profitable, carving their own path without the pressures of the stock exchange. The real question lies in what founders want their companies to stand for. If the mission is rapid expansion, disruption at scale, and global recognition, then chasing a unicorn valuation might be the right step. If the goal is stability, discipline, and long-term growth with broader access to capital, then an IPO may provide the stronger foundation. It also comes down to timing. Markets fluctuate, investor sentiment shifts, and economic climate changes. A unicorn valuation achieved in a booming private market might not hold when public investors take a closer look. Likewise, the appetite for IPOs ebbs and flows. Timing an exit wrong can have lasting consequences, while waiting too long can leave opportunities on the table. There's also the matter of culture. Some companies thrive in the high-octane environment of private fundraising, where stories and visions dominate. Others are better suited to the transparent discipline of public reporting. Neither path is inherently superior, but one will feel more natural depending on the DNA of your business. Ultimately, the decision is less about unicorn versus IPO and more about the identity of your startup. Are you building a company that can sustain itself beyond the glamour of valuations and beyond the adrenaline of a stock market debut? Remember, success isn't in the label, but it's in the endurance of the business, the team behind it, and the value it brings to customers.